What's up, folks? This is Jason, host of Fighting Words Financial, and I am back today with a couple of things I wanted to talk about in the news, and one sort of general thing I want to talk about, which is sequence of return risk. That's a really long phrase that just basically says that the order of your returns matters, and we're going to talk about why that matters in today's environment. It looks like, all right, okay. So it looks like markets are coming up here, but I've been paying attention to the markets a little bit today. It's basically flat. We had a flat Monday, a down yesterday, and kind of a flat today. Not a ton of earth-shattering news out there on the economic front. A lot of it on the political front, but not a ton on the economic front right here. But I do want to sort of set up just an alert here when it comes to Tesla. I said this a couple of times in the last couple of weeks that the news for Tesla over the next 2 months is probably going to be fairly negative. Now, I take a longer term approach, of course, when I'm looking at any investment that I might make. But in terms of Tesla, I think that there's an opportunity here if you're looking to get into the stock, especially prior to a likely split that is going to happen in August. So ignore the blinking advertisements. I'm not sure why it keeps loading here, but look, Tesla is likely to announce global production and delivery data for the second quarter later on this week. I think we all know that delivery data is going to be down largely because of supply chain issues and because Giga Shanghai was shut down, and also it was shut down completely for a while, and then it was limited to a single shift that was in like a closed loop where the workers slept at the factory and that sort of thing. And so delivery estimates have been revised downward by most analysts. They expect them to deliver 265,000 vehicles in Q2, and I think somebody is predicting as low as 245,000. So I wouldn't be surprised if it actually came in lower than that. I'm not sure what degree of insight folks have, these analysts have on the actual production numbers going on inside of Giga Shanghai as they're coming out. Elon Musk also made this announcement that right now that Giga Austin and Berlin, they are slowing, they're having a slow ramp up of production. They are absolutely getting crushed in terms of supply chain issues, and they're losing billions of dollars at this point. So the ramp up of every Tesla factory has resulted in losses of in the billions, right? This is nothing new, but every time this news comes out, it causes the stock to temporarily slump and creates a buying opportunity. Now, I personally have really only bought Tesla shares twice, once way back in 2011 and again in 2016. Only time I've bought Tesla shares, and I've really benefited from the split and riding the stock upwards, right? But if you are looking to get into this company and you have a long enough view, long enough horizon on what's going on here, I do think that between now and probably August, there's going to be plenty of opportunity, especially in light of the struggles to ramp up production of the Model A and Model Y. There is a shortage of battery cells. There's a shortage of battery cells for both the 2170 and the 4680, which of course Tesla's the only one that produces that. I keep hearing rumors. I keep hearing rumors that there's going to be a deal with BYD to use the Blade battery. Those rumors, as of yet, have not really been substantiated by any sort of deal that has been inked, right? So, Also, there is a planned reboot for July for Shanghai. That factory is going to be shut down for up to 2 weeks. But the aim is to substantially increase production capacity in that time period. Right now, they're producing about 17,000 Model 3 and Model Y per week. They're going to revamp the factory a little bit, and they should be up to producing 22,000 units per week of those two models. So all of this actually, it sounds like bad news, but this is all things that are set to improve here in the future. And it's setting themselves up for better production, in future months. So yeah, let me see here. I have a question here. Paula Mateus, and for some reason it's kind of slow to show up here, but it says, hi from UK. Since you acknowledge the fact that not investing in Apple was a mistake, why don't you consider opening up a position in this bear market? You might have a good entry point soon. I agree with that statement. I really do. And I'll probably end up doing that. I own, of course, Apple through ETFs and that sort of thing. With a lot of stocks, I'm happy to do that. I've been kind of kicking myself over the years, over and over and over, when I look at this company and I've kind of missed out on investing because I'm thinking that the major gains have already been made. How much further can they grow? How is the culture of innovation going to survive the death of Steve Jobs? I was wrong on pretty much every one of those accounts. And also, being an extremely tech oriented person, I was never able to really see the value of top line Apple tech, in a side by comparison with top line tech from Google. And I'm really thinking of the Android platform. And I'm not talking about their $100 phones that you get. I'm talking about the top of the line phone, Android phone right next to the top of line Apple phone or any product. I wasn't really seeing the advantage. What I underestimated was the power of branding, this cult following that Apple had, which no other company in the tech space has really been able to create that. So I completely underestimated that, which is me underestimating that in my other area of interest, which is electrified transportation. So I've liked Neo since the beginning, but I've liked them in sort of a limited way, and I actually study the history of manufacturing quite a bit. I know that's really boring for some people, but I study the history of manufacturing quite a bit. And Neo has made a couple of stumbles here in the last couple of years, and they have some issues when it comes to their balance sheet. I do want to talk about that short seller report, though, that was out. I did review that short seller report in detail, and I'm going to say that, and I don't say this in all cases, of course, but that Neo's response to that was rather weak, but they are right about the short seller report. There's not a lot in there, right? The claim is that Neo has only sold about 19,000 battery as a service subscriptions, and they delivered something like 44,000 batteries to this company, and they went ahead and recognized that income right away, or that revenue right away, rather than stretching it out over time. And they claim 19,000 batteries of service subscriptions. Then why do you have to have 44,000 batteries? That question is in the report is kind of dumb, actually. Even in a perfect world where you could predict where everyone was able to travel and you had 19,000 people subscribe to battery as a service, you'd still need at least a bare minimum of 24,000 delivered batteries, because those batteries hold 5 batteries. You got one in there, swapping it out. And that's also that's the original version had 5. I think the new one has 13. But if you're cycling out a battery every 10 minutes or so, and I know it could actually be done faster, and the newer version 2 stations have 13 batteries, you're going to run out of batteries rather quickly in that, and because they need time to recharge as well, right? So there's always going to be more batteries provided to batteries as a service. Because the bare minimum in the most perfect of worlds would be 20% using the version 1 of the battery swap station. Technology has improved since then, and like I said, you cannot predict usage. They have to have enough batteries in reserve to charge, to handle charge times of the batteries, or to actually deliver batteries on site to satisfy a swapping need. So when I dug into the report, my first thought was, this is a company that has shorted this stock, and this stock is up in the last couple of weeks. So I would take that actual short seller report with a very, very healthy grain of salt. I don't believe that I don't. It's not that I don't believe a word. It's just really being misinterpreted. Back to Tesla for a little bit. There was also a little bit of rumbling today about the fact that Tesla has laid off a bunch of their folks that are involved in self-driving. So a lot of those folks were people that handle data in one, and let's not forget, this is a part of the company that's expanded really, really rapidly. So they shut down this facility in California. They moved about 150 of those software people to another facility nearby, and they laid off about 200 hourly workers. So there's a couple of things going on with that too. I'm not sure exactly what their jobs were, but there are many instances when I worked in the software industry where laid off entire departments because we're not able to develop the type of results that I wanted. All right. And Tesla may have been looking for an opportunity to do this. And there was also a reason that these folks were hourly and they weren't full-time employees. There are 100 different reasons why that could be. It may be that their use on that project had sort of a limited time. It may be that the project is high demand and people burn out very quickly. Or they want to get rid of people very quickly. There's a lot of reasons why that could have happened. Okay. Let me see here. Not sure why Koifin is not loading today, but I'm going to go ahead and reload that. So if you look at Gasco, which is a website for China Automotive News, and we take a look at top stories for NIO on here, there is no mention of the short seller report, which I find very curious. And there's not a lot of news period going out with NIO. So so normally this is a really good source for news in China when it comes to the EV industry. I'm going to have to say that this is curated news in this case, and it's missing because I think this is frequented by a lot of people who are not Chinese nationals that are looking for information on the EV sector there. This is one example of news curation where we're not really getting what we thought we were getting. So, okay, so I'm going to move on here to kind of an important concept. This came up in a conversation I had with someone else in the industry recently, where we were talking about folks that are withdrawing money from their accounts, either to live on pre-retirement or in retirement, or you're trying to do the whole FIRE thing, financial independence, retire early. You're living off your portfolio. The order of your returns matters. This is called sequence of return risk. And let's talk about why this matters. And this happened a couple of times in history, and I'm really thinking of like 1973, 1974 in that time period. But we're looking here. We look at Jane's portfolio and Jim's portfolio. Both of these people have a beginning balance of $500,000 a year. Both of these people are taking $20,000 a year in withdrawal, and they're going to increase that a little bit by inflation each year. And the issue is here is they actually have the same returns. They're just inverted, meaning that we start with a 10.14% return here, and we end with a negative 0.3. I'm sorry, with a negative 10.14% return right here, and we end with a negative 0.73% return. We flip that order around for Jim, and he starts off with a negative 0.73% return and ends up with a negative 10.14% return. But the returns year by year are exactly the same. The order is just flipped. But what you can see here is that by the end of Jane's lifetime here at 81, and okay, I think a lot of folks are going to live past 81, but let's look at that. Her ending balance is $74,300, and yet she had the exact same returns as Jim did. She took the same withdrawals as Jim did, yet she ran out of money because these negative returns here happened at the very beginning of her retirement. Whereas Jim had relatively positive returns at the beginning of his retirement, relatively negative returns at the end of his retirement or life. He has an ending balance of $344,290 while taking out the exact same amount of withdrawals. This is the risk that you're running right now if you're trying to trade options on your account and live off of the income derived from the options rather than reinvesting that right now. This is the risk that you're running right now of having like two negative returns in a row, like say this year and next year, early in your retirement. And I think it's a really big risk. And if you are taking withdrawals off of your account right now, particularly in withdrawals that are way ahead of the income that you're earning, then I think you may want to reconsider what your discretionary expenses are, right? And this is a conversation that I have a lot with people. One of the secrets to being financially successful and financially secure is to have a flexible spending plan, meaning to get your fixed expenses as low as you possibly can, to spend a little bit more when times are really good and be able to spend a little bit less when times are a little bit bad, and be able to really draw back on your expenses and still enjoy your life when we have a series of negative returns. So a couple of times in history, this has happened. 1973, 1974 was probably the biggest example of that. And there's historical sort of connections here. And because 1973, I think you had negative 23% return. 1974, I think you had negative 24% return. And at the same time, we were going through a pretty protracted period of high inflation, which peaked in the early 1980s. So I think that these annual withdrawals in that case would actually be completely unrealistic. And this is looking at sort of a normal market with low inflation. If you have these negative returns in the first couple of years of retirement or your first couple of years of investments, you're trying to withdraw off of the portfolio. If prices are rising, you're going to need to withdraw more and more and more, and your losses in that time period would absolutely be magnified. So a couple of people are taking this risk right now. People that are thinking that they're going to earn enough money off of options to be able to support their lifestyle by selling covered calls or by buying puts, cash secure puts, or even puts on margin in this case. If the market does very poorly for a little while or for a while, you're selling options, you're gathering a little bit of income. The income you're getting from selling those covered calls is actually declining as the market goes down, as the value of the stock that you're selling the right to purchase goes down as well. So your income declines and you start to take more and more risk. And the difference between the strike, the strike price there and the actual price gets smaller and smaller and smaller because you're trying to generate the income you had before. There's a risk there that those funds are going to get called away. And when they get called away, you may blow way past your strike price. And this happens with really volatile stocks. You'll blow way past your strike price. And so getting back into that stock, if the market turns around at some point, may be impossible to get back in with the same amount of shares using the same amount of money that you generated in that case. You may actually have to spend more money to buy that same 100 shares to get back to a point where you can start earning income. And that's kind of a major concern that I have right now with a lot of people that I've talked to who seem to think that, or who have selling covered calls and cash secured puts as kind of their only strategy here. It's very easy to start taking more and more risk as the stock goes down, thinking I've got to earn more and more money. Like I've already accepted the fact that there are certain stocks right now that I'm just no longer selling options on because the price is so low. I feel like it's going to turn around really quickly. What is it? Upstart is one of those. I'm not selling any options on that right now. SoFi is one of those. I'm not really selling any options. Well, I'm selling options that I'm just not generating a lot of money just because they're so far, my strike price is so far up there that it's really unlikely to be in the money at expiration. So generally I like to, in terms of income, I like to sell my options with a delta of about 0.8, right? Where there's a roughly a 0.2, where there's roughly an 80% chance that option will expire out of the money, right? Right now, the income derived from something like that is really, really low, and it's not great. But I'm still taking that and I'm reinvesting that. I'm not withdrawing anything from my portfolio, and I'm buying stocks that I think are on sale at this point. So Stephen Kua asks about what do you think about BYD's high price to earnings ratio? Is it overvalued? That's an interesting question right now. If we look at BYD's high PDE ratio in comparison to everyone else in the EV space, I don't think it's going to look that bad. But is BYD really an auto manufacturer, right? One of their biggest, they're really looked at more outside of the United States. They're really looked at as a battery producer, right? They still produce a lot of batteries, not just for the EV industry, but for industries, all across the world. And I'm talking about like watch batteries, phone batteries, anything that needs energy storage. They're also some of the leaders in battery technology innovation as well. Take a look at their Blade battery. They took very cheap materials, an older idea, and turn that into a very safe and only slightly less energy efficient battery than some of the best batteries that are out there. And they're doing it for about half the cost. I think one of the things we're going to see is that as production ramps up for the new Blade battery, that they are going to be supplying that Blade battery to a number of different startups in China. And of course, there's also the rumor that they're going to be providing that battery for Tesla as well for export. So I'm I understand your concern that there's a high PE ratio. I also want to point out that BYD gets punished in U.S. markets a little bit because it's not traded on the NASDAQ or the New York Stock Exchange. It's traded over the counter, or you can buy 8 shares. And also, there's always a bit of a discount with any Chinese stock simply because it is a Chinese stock. So, so I would, those are all things that I would try to keep in, that I would try to keep in mind while I'm trying to think about whether or not I would invest in BYD. As much as I talk about BYD, I actually don't have that many shares. I've got 100 shares of BYD. So I'm trying to bring up markets and see where they finished today, not having a good, a lot of luck there right now. So let's take a look at what Patrick Mulligan has to say. He said he also looked at the Grizzly Neo report and didn't see much substance. Looks like anybody can do a hit job on a company they have shorted. It does not seem fair. Well, it's just simply legal to do that. Like, as long as you disclose that you have a short position in a company and you stand to profit if the company goes down in value, then you are allowed to say whatever you want to say, so as long as it isn't it's not slander. If it's written, it's libel, right? So, and as long as you're not lying about it, and technically they're not lying about it, right? They are pointing out, they're basically doing a Tucker Carlson job on Neo, just saying, well, why are things like this? And I'm looking at the substance of that report and saying that there's not a lot there either. There are 100 different reasons why you would have twice as many batteries as you do subscribers. And a lot of that has to do with simply building out the network of battery swapping stations, right? So, and that's something that they're doing really rapidly to do that. So let's talk about what battery swapping is. Battery swapping is not and the way it's done, it is not a technological innovation that Neo came up with. I know that people tout all of these patents, but they're really just derivatives on patents that was done by an Israeli company, I think back in 2008. I don't remember the name of the company, but they had operations in Israel and Denmark and in California, and that company ended up failing, right? But the idea, you can't patent like an idea, battery swapping, and say no one else can do that, right? I'm sure what they patented is a lot of their automation technology. But to what battery swapping really is, though, it is actually a financial innovation, not a technological innovation, right? It's a financial innovation designed to reduce the upfront cost of Neo's vehicles and bring some of their models down to a level where they qualify for a certain subsidy from the Chinese government. And it's a substantial subsidy. And that's what it really is. There is the danger that China ends these subsidies at some point, and that financial innovation becomes much less valuable. And I've said this since 2020, that I don't believe that battery swapping is part of the permanent strategy of Neo, because we can all see technological innovations coming down the road when it comes to battery charging. It's getting more and more rapid. Supercharging networks, not just Teslas, but Neos and Xpeng's networks. And Neo and Xpeng can share charging networks, by the way. Those are becoming wider and wider out there. Those networks are. There are third-party companies that are just concentrating on charging networks. Those are getting better. We're probably going to see cities in China get into, well, basically every parking spot might have at least a trickle charger in there at some point. Cities are going to get in on this. They're going to start charging for parking. And when you pay for parking, you're going to be able to, charge your vehicle as well. So I don't see a ton of money to be made in charging infrastructure for the average investor, because I think there's going to be tons of like destructive competition in there. I don't get excited about the battery swapping technology, other than I think it's kind of cool. But I saw someone made a comment the other day on my channel saying that Neo's battery swap stations are going to become service stations. Have you guys ever seen a picture of the battery swap station? Let's take a look at the battery swap station here. It's not going to become a service station, right? The way this works, and this is actually genius, is that right there. Basically, it's the size of 2 parking spots or maybe 3 parking spots. This thing holds 13 batteries. This is a version 2. It doesn't require a technician there or any sort like that. And it can charge the batteries on site. But even with 13 batteries, if you can really change out a battery in 3 minutes, like they're saying, you're not going to be able to charge the battery in that time period. So there's going to have to be some sort of like delivery mechanism involved there. But this is not going to become a service station of some sort. Something new is going to evolve, like like parking lots full of battery swapping stations. Maybe you can go buy a sandwich or something or whatever. I think that supercharging stations where you actually plug your own car in and you walk away from it instead of changing the battery out in 3 minutes, that's more likely to develop into the Chinese version of Buc-ee's. And if you guys have never been to a Buc-ee's in Texas or other places in the South, you should. It's like a gas station that doubles as a Walmart and a State Fair at the same time. It's really interesting. You can get some very interesting foods there, and I do see that is the direction that charging infrastructure in the United States is pretty going. Yeah. So Epic Hamster says, I see you don't follow Hyliion very much, but didn't you see the news about working with Cummins? I think Cummins eventually buys them, which hurts my upside potential. Cummins actually bought another company that I was interested in years and years and years ago. I want to say this is back in like the 2006 timeframe. They bought Westport Energy, which produced a conversion kit that converted diesel motors to use renewable natural gas, right? So I actually do follow Hyliion. I just don't do a lot of videos on them. It's been kind of a dead investment since the very first day that I made my first video. They were a pre-revenue company. I actually made a pretty big mistake in my first video where I misinterpreted sort of the number of units they had sold to different fleets, and I kind of backed on that because I made a really big mistake in that video. But no, I do follow Hyliion. I like Jeff Healy a lot as a CEO. He has a real engineering background. He really knows what he's talking about. He doesn't talk about much besides his business, doesn't engage in politics or anything like that. And I think that the sort of two-tiered approach that Hyliion is taking, and I'm really paying attention to that Hypertruck ERX system that they're coming out with, where it's a fuel agnostic system, meaning it's battery electric, and they have a battery electric only drivetrain in combination with a generator on board, sort of like my least favorite company on the planet, Nikola. But they actually have an engineer in charge of making all of the talking points instead of Trevor freaking Milton, or that was his name. Which, by the way, he kind of got away with that. Trevor Milton basically got away with bilking people out of billions of dollars. He really didn't suffer any consequences for basically creating this giant vaporware production when it came to Nikola, right? The Nikola Badger, which was canceled, essentially was a $12 billion piece of digital artwork. All they really produced were digital mock-ups of that and pictures of that, and they were able to pump the valuation of the company up to somewhere like $12 billion at one point. And Trevor Milton cashed out on that, bought a $30 or $70 million ranch. I don't know. He's been involved in some legal stuff, but we really haven't heard from him. But he basically got away with it. Yeah. So, yeah. No. So NIO's business model is something that we're going to be talking about for years and years and years. It is way more complex than the average person who doesn't speak Chinese can get into. I've actually paid people to translate filings in China for me. I've paid people to translate, news articles that I couldn't find translated anywhere else. And it's actually been, it's been really fascinating. There's a lot more going on than we thought. But my main issue is they've got to start producing more vehicles. Just like Tesla, they can pretty much sell as many vehicles as they can produce, they can sell, but they seem to be suffering a little bit more from supply chain woes than XPeng is. And I know that Li Auto has gotten a lot of press lately, and they've come out with a new vehicle, which is not substantially different than the vehicle that they already have. They're still sticking with their hybrid strategy, where this is a plug-in hybrid vehicle. You've got somewhere between 70 and 130 miles of range, depending on how you drive, 70, 130 miles of range just on battery power as a commuter vehicle. And then the generator kicks on. I know some people claim that's not a green vehicle, but there's lots of people that live in China that are going to use battery power for a lot of this, and they're not really, and they wouldn't buy a vehicle because of range anxiety, right? They wouldn't buy a purely electric vehicle because of range anxiety. So it's a step in the right direction towards towards electrifying transportation, right? It's definitely a step in there, and it's superior to the previous generation of hybrids that we had available through Toyota. Now, I own a hybrid. It's a great vehicle, but it's only marginally more efficient than having a gasoline vehicle in the same, or a really efficient gasoline vehicle in the same class. And I like to play the game of seeing exactly how long I can, keep it running just on battery power. And I'm telling you, it's not really that much. So, what happened to Upstart today? I don't know. What did happen to Upstart today? So let's see. And Upstart is just simply a highly volatile stock, by the way. It is just extremely volatile. So yeah, down 10% today. Let me see. Is there any like specific news on Upstart? And I bet there won't be a ton of specific news. Even though I haven't looked at the news for Upstart today, I'm gonna bet that there's not a ton of specific news. Yep. It looks like it was downgraded to underweight, but as Morgan Stanley rates rise. So the concern with Upstart is the quality of their current portfolio right now, right? They're part of the new generation of AI-driven lending platforms, and one of their big thesis they had was that a lot of people are sort of unfairly penalized by the old credit rating system, and there are different ways to evaluate whether or not someone is a good credit risk. Well, that entire position is really untested, right? It should have gotten tested in 2020, but then we had the stimulus payments to sort of make up for a lot of that, and people were able to keep up with their debt. The other concern that people have with Upstart's portfolio is the fact that it is mostly personal loans, right? And mostly personal loans where there's no collateral provided. So it's not like a car loan or a home loan, which means there's a greater degree of risk assumed in that. Now, that greater degree of risk with their current portfolio really didn't result in a lot of extra return because interest rates were so low. So Morgan Stanley downgrading this on interest rates rising means that they're predicting that some of those loans that are actually at artificially low rates made in the last couple of years they're still going to be in default. There's going to be a swapping of people in that portfolio of loans as time goes on, and we see credit spreads increase between what they have in deposits and what Upstart can get the money for in deposits and what they can loan it out for, and you're going to see an increase in profits as time goes on. But this is a company that's already been profitable. I don't expect to see the same sort of earnings growth this year that we saw with them in past years. I do expect that to pick back up, though, as people get used to a higher interest rate environment. Loans still happen in a higher interest rate environment. They are just more expensive. Right now, we are suffering from definite shock when it comes to interest rates. I think the entire population is suffering from interest rate shock. I'm old enough to remember that the interest rate on my first home was 9.5%. Okay. So, and I know that sounds unbelievable, but I bought my first home in the 1990s and it was at 9.5%. And I was young, and I'm sure the bank considered that a risk. I didn't have a really long work history at that point. So, yeah, Upstart is a stock that I actually own 100 shares of. I'm actually like 112 because I've been adding a few shares here and there when I've generate a little bit of money by selling covered calls, or if I have a little money left over after I'm done paying all of my bills. That is something that I'm adding, and I was looking forward to adding it. As I saw the price come down, I really liked it at $75 a share. I ended up buying it at around 27, 28, and then it went up, and then I bought a little bit more at 35. But my average cost for my 100 shares is probably around $34 a share in total. So not happy with the fact that now I'm down on this stock, but I am adding this as we go along. So whenever you're looking at analyst price targets, remember that their price targets are only set for about 12 months. As an investor, if you're only investing for the next 12 months, that's actually pretty crazy. You really should be having a much longer time horizon. The longer your time horizon is, the less likely it is you're actually going to lose money over time. And so I don't actually think most of the time about how much money I'm going to make. I think about how much risk am I taking. What is the likelihood that 5 years from now this stock is going to be below what I paid it for? Am I going to make more than inflation? And that's kind of the thought process that I go through. And like when it comes to value stocks, I like to use a dividend growth model for a lot of my really large S&P 500 stocks. Although I haven't bought those in years, I use dividend growth model. So Warren Buffett, he's on a buying spree right now. He's buying things left and right. Hold on, I gotta block someone out of here, and I gotta block this user advertising naked something or other. Bro, it says naked something cheapest Tinder just for sex, and blocked him. All right. So anyway, not contributing to the conversation. Go away, dude. Anyway, so Warren Buffett's been on a buying spree after about 2 years of being ridiculed by people, and like David Portnoy of all people. I don't care what he thinks of being an investor, and I thought his criticisms of Warren Buffett were ludicrous at best. And this is something that Warren Buffett has faced his entire career. Warren Buffett is almost strictly a value investor. He did make a few investments in the last couple of years that kind of confused me, like the Snowflake investment. That is something that seems sort of not very characteristic of how he normally invests. And actually, originally the BYD investment, in terms of their overall portfolio, I think it was only a couple of $1 billion, like $10 billion or something originally, but he basically 10x that. That didn't make a lot of sense to me when it started, right? And I did a video. One of my first videos I did on BYD was why was he really interested? And in some of the comments, it was really misinterpreted. He was interested in BYD as a battery producer, but because he saw that the increase in demand, the demand for lithium-ion batteries was simply going to increase, and he saw that BYD had good personalities in charge of it. They had an innovative culture. They were a large company. They were really established. They were politically connected, and it had the right personalities in charge, right? He wasn't. I mean, they made vehicles, but they weren't. Their vehicle line really wasn't the largest part of their revenues at that point, and it may not still be the largest part of their revenues. I'm not really sure. I haven't taken a look at their latest quarterly report, but this was a value investment. He is strictly a value investor. So last year, when everyone was investing in technology, and really the only technology investment he made was Snowflake, it's because he didn't see value in the market, right? He's trying to get $1 worth of value for as little as possible. He's trying to buy companies that are on sale. He thinks about growth, sure, but he's trying to buy each company at the right price and dispose of it when it gets to full value and it looks like that the growth expectations are going to be lower than overall growth of the market over time, which means that his theoretical holding period for any particular stock is forever. Now, my theoretical holding period for any particular stock is forever as well. I tend not to even think about disposing it for the first 5 to 7 years. But in reality, though, we have to look at his returns in this time period. The strategy of value, while it has underperformed other strategies in the last 2 decades or so, it has been out of fashion for the last two decades or so. You couldn't really say that about Warren Buffett's returns on his portfolio over that same 20-year time period. He's a really, really good value investor. He's really focused on current cash flows, whether or not the price of the stock really represents what those current cash flows are. And he's looking to buy stocks that are not represented by their current cash flows. The last 2 years, we really should have been listening to him, even as technology investors to some degree, where we're really betting on explosive growth here. We're really betting on mass adoption in a lot of cases. And that doesn't always happen no matter how great the idea is. And I'll give you an example. So Rio's MP3 player came out actually before Apple's did, and it was actually really, really good. And I had one, and I was able to plug it into my car and listen to MP3s. I was able to download music illegally back then, like everyone was doing. We didn't really understand that it was illegal at first, but I was able to do that. I thought this product was great, and it was going to blow up, and it basically never went anywhere. And it wasn't until I think almost 4 years later that that Apple's iPod came out. And when the iPod came out, I thought that it would have the same level of success that Rio's Player did, which meant not a lot. And I thought it was a strategic mistake on the part of Apple to go into this direction. It really seemed like a backward step in terms of technology. And boy, was I wrong on that, right? There was just a time for that adoption to happen. But why didn't the adoption of Rio happen? Like their MP3 player at the time was about the size of a deck of cards, at least the one I had. And by the time the first iPods came out, theirs was about the size of a deck of cards, just about half as thin, right? So the only difference really for me between Rio's was that Rio's had buttons. It was a little bit thicker, but I got it 4 years earlier. And when the iPod came out, it was a little bit thinner and didn't have any buttons. Why was Apple's more? Why was it better? And there were a couple of ways that could have gone wrong too. It was a giant departure from what they had been doing before, but they really had that serious backing of their cult, basically, of the people who are willing to buy Apple products. They had already developed that, and that was something that I didn't understand was the huge lock they had that power branding. I'm looking at Apple in that time period, they had less than a 10% market share of desktops. They really didn't have any sort of products available in like laptops or anything like that. It just wasn't there. And this is, of course, before iPhones and before smartphones in general. And I'm looking at that, and I didn't understand they already had that branding power, and they had it really from people that were involved in publishing and people that were involved in tech and these sort of contrarian, these upper middle class contrarian people that work in tech. Like to this day, there's no reason for me to use any sort of Apple desktop. There just isn't. But back then, for a few different reasons, there was. Like if you were involved in publishing, there was some great software on that. If you were involved in image editing or video editing, they had sort of the most advanced software, or at least the community thought they had the most advanced software in that time period. But it was less than 10% of the overall PC market share. And they were able to leverage the iPod into doing many other things in the technology world in terms of portable technology. And that was something that was really hard to predict. And it was one of the big failings I had as an investor. A lot of the things we think right now are sure winners in technology are going to end up like Rio. They have a great product. They aren't able to establish a brand. They aren't able to market it properly. They're going to get bought out for pennies on the dollar, and that's what happened to Rio. They got bought out for pennies on the dollar, and the company just basically sputtered, and the brand has eventually been shut down. Right, a lot of that's going to happen. So this is something that Warren Buffett doesn't invest in. He invests generally, not all the time, in more established companies who have some sort of competitive advantage. He realizes the competitive advantage isn't permanent, but he's looking for current cash flows that don't match the price. Meaning that if you look at average price to earnings ratio for an industry being 18, he's looking at P/Es in 12 or something like that. He's also looking at dividend growth, the dividend growth model, right? Where you're taking the rate that dividends grew in the past, you're comparing that to current price, and you're projecting in the future what you think current price is today's price undervalued when you work backwards. And from what I understand, based on my research in him, the dividend growth model is one of the primary ways that he is able to put a value on a stock. How was he able to do that in 2020? Well, he wasn't. He was happier taking the criticism, sitting on his giant mountain of cash, and waiting for a better opportunity to invest. And right now is when he is investing. I've seen article after article after article in the last 2 months about him taking positions in companies. And some of these are companies that I would not have expected him to take a position in. And so I'm actually very curious as to, at the time period where I'm seeing more doom and gloom out there from the average person in the economy, from the average worker, from the average person investor. I'm seeing more doom and gloom out there. And yet the smartest investor of the last 50 years is out there buying up things like a drunken sailor. Not really like a drunken sailor, like a very smart sailor. All right. So pay attention to what he's doing, right? Pay attention to the stocks that he's buying. Think about the reasons why he might be buying these stocks. He may have different opinions than you are, and you may be able to extrapolate off of what he's doing and look for a different idea that it kind of travels in that same vein, right? So he was interested in battery technology when he took this giant position in BYD. That seemed like it was out of the ordinary. It really wasn't. It was about projecting for the future. This was a company that was already large. It was established. It was publicly traded in a couple of different markets. They were paying a dividend, right? And they had good leadership in place. These are the kind of companies that I'm looking at right now to expand my holdings in if we really are going through a period of abnormally high inflation. And a period of abnormally high inflation would be inflation over a rate of about 2.44% sustained over time. Even if we reduce inflation rates well beyond the 8.6% that is right now, I don't think that I think it's going to be a little while before we see inflation rates return back to that 2%. But we're looking at inflation rates over a really long period. The difference between 2.44% and 2.78% over a 30-year period, compounding that entire time, that's actually a huge difference. And that's something we're going to have to talk about over and over and over here in the future. And so he's the guy that I would be paying attention to right now, not David Portnoy, not average person on YouTube in this case. And it's not just a tried and true method as well. People underestimate how forward thinking the guy is. And you're thinking, guy's almost 90 years old. How forward thinking can he be? He's still pretty forward thinking. He's not thinking just in terms of his own lifetime. He's thinking of setting wealth up for future generations of Berkshire Hathaway investors. So a couple of other companies are kind of working this way, but don't look the same. Amazon is one of those companies that works a lot the way Berkshire Hathaway is. But they're just looking to take over the entire retail space. But if you look at all the different directions they're going technology-wise, all the different investments they're making in transportation, in logistics, in AI, in owning a large part of the cloud, you start to realize that Amazon is one of those investments that may not seem all that undervalued right now because of where the price. I know they just recently had a 20-to-1 split, but it might not seem all that undervalued right now. But if you look at where they're going in the future, that's one of those things I'd be paying attention to. There are a number of different companies that are like this. Tesla is one of those, although I wouldn't exactly say it's undervalued. I'm just saying that the future propositions for Tesla look pretty good. NVIDIA is probably the one company that I would say that I'm surprised that a person like Warren Buffett isn't supremely interested in NVIDIA at this time period. If you look at the way the world is going, the way technology is going, they are pretty much positioned for everything that is coming down the road here. But we take a look at markets today, basically flat. The Dow Jones was up 82 points, about 0.3. The NASDAQ was up 20, which is kind of a surprise. It was down this morning. The S&P 500 was down a little bit. So it's a flat day in the market. Look, no news is good news in these troubled market times. I think not Morgan Stanley, it was Merrill Lynch predicting a 50% chance of recession. We now have confirmation that in first quarter of 2022, the overall GDP declined by, I think, 1.6%. Not a huge disaster, of course. To qualify for a recession, we need 3 consecutive quarters, academically to qualify for a recession, 3 consecutive quarters of declining GDP. GDP may not have declined for this quarter because of an increase in spending for services. And that's one of the things that people are saying is there may be a surprise this quarter that there's been an increase in purchases for services. We are not we could be kind of in a recession, but we're not technically in a recession. But remember, employment is still really high at this point. It's still under 4%. Typically, when we have a recession, we have unemployment at north of 6%. Usually, sometimes as high as 10%, but usually north of about 6%. Recessions typically last 9 to 12 months, and then they're over. Bear market ends a lot more quickly than that. So, fire away with questions, guys. I'm happy to answer anything. That was kind of my rant. I don't know how I got from Hyliion all the way over to this when we started about talking about working with Cummins. But make a further point of Hyliion. So I think Hyliion's really likely to be an acquisition candidate. I think that somebody like Dana International or Cummins is actually going to end up buying them. And if you look at the strategy Cummins took with Westport, this is exactly the strategy they took with Westport when they decided to eventually purchase the technology. The sad thing about that is I haven't done anything with Westport's technology. So they had this conversion kit where they convert your diesel engine to use natural gas. They really didn't do anything with it. They really didn't promote it. So Dana International, which provides parts for companies, they have their own electrification plans for Class 8 trucking, where they're basically going to electrify that rear axle, use it to reduce fuel costs. They're going to use regenerative braking, and they're basically trying to turn every Class 8 truck into a hybrid, essentially. So I think that a partnership or a buyout from Dana is probably a lot less likely in that case. And I think they're going to, because they're working with PACCAR and a couple of other folks that are involved in that Class 8 trucking market. And that's the real target for the electrification of trucking is Class 8, because that's how we get a majority of goods around our country, because we have an underdeveloped rail network, and our cities were not designed in, our cities weren't built in design in the age of rail like European cities were. They were built in design in the age of the truck, right? And like when everyone talks about European cities and and public transportation, these cities were built when there weren't cars, right? And so it was a lot easier and a lot less expensive to put in public transportation because they were built in the age of rail, and the rail lines are already existing. And there are a variety of different factors. It's not quite as simple as that, of course, but yes. Michael Will says, you did videos on NVIDIA recently. Are you planning any more on other companies? Oh yeah. I'm always planning videos on companies. The problem I've had recently is a little bit of inspiration. I don't like to make a video and say, hey, I'm recommending you guys go out and buy this company. I like to talk about what they're doing and sort of leave the decision to invest in that company up to you. NVIDIA is doing so much and it keeps changing that I keep scrapping what I'm doing. So I did one on NVIDIA recently, and then I did another video on a sort of $13 trillion opportunity for the metaverse, and that ended up being pretty NVIDIA heavy. Largely because the metaverse for NVIDIA goes far beyond just gaming, and there's a lot of industrial and medical applications for the metaverse. Particularly, and this is the more I dig into this, the more I find out that molecular modeling is going to be one of the biggest applications for Omniverse. I don't know if it's going to be the biggest money maker they have for Omniverse, but it's definitely going to be it's definitely going to be a big deal for usage, right? Patrick Mulligan says, I like Disney at this level for long term. I do too. I don't like what Disney's done with the Star Wars franchise. I really don't. The series have been kind of like hit or miss, but they're all cash cows. They know how to take an original idea and monetize it. And if you look at the acquisitions that they're making in terms of properties, in terms of like cinematic universes that are being created, they are going to be able to make money for a long, long time. They're going to be able to plow that back into development of new ideas. And so I think that is, I think Disney at this level looks like, and I think that their streaming business is only going to grow. They have a lock on some of the best content that's out there. They're a little bit afraid of developing certain types of content, and I think that at least in the theaters, and I think that some of those reservations are going to go away with their streaming environment because you have a lot more control. Parents have a lot more control over how that's done. I'm talking about some of the more they've shied away in the past from some of the more violent content that's out there, or the more controversial content that's out there that actually sells. And I do think that their streaming platform is going to allow them to sort of explore that a little bit more. So, do you have an opinion on DraftKings for the long term? I don't. It's not that I haven't taken a look at the company over and over and over. I don't own any stock in it. The problem is I'm just not a gambler, um, and I'm not a gamer, not like a real gamer at least. And I have a problem seeing how this gets sustained over time. Like, how popular is this movement? How sustainable is this movement? I know that gambling has been around forever. Like, you can go to um, I don't know if I've ever discussed this, but one of my degrees is I think one of my degrees is in archaeology, and you do a lot of studying of like pre-industrial societies and hunter-gatherer societies. But even in modern hunter-gatherer societies, like the Khoisan and like people in South America, they spend a lot of time gambling, even though they don't have money. They play a variety of games using different mediums of exchange um, for a number of different things. And so human societies gamble even when there's no money involved. And they do it all the way back in our past to like to hunter gatherer level where they don't have much contact with like civilizations who gamble for money, but yet they still do it. It's something that's probably hardwired into us and DraftKings has a really good position in terms of branding. They have a really good position in terms of how soon they got out there. But in terms of a long-term opinion, I've actually struggled over and over and over to form a long-term opinion on this company. And I think it's because there's just a disconnect with me when it comes to gambling. It's like I do all my gambling in the stock market, man. I don't do it anywhere else. And you know, when you do that in the stock market, you think you're doing things all the time for the right reason when you really aren't for a lot of people. And a lot of what you're doing, a lot of what a lot of people are doing in the stock market is gambling. I like to think that I'm not doing that, but the reality is, to some degree, I'm doing the same thing. So, yeah, that's an interesting question. Have you, formed a long-term opinion of DraftKings? No, and that's a really long answer to say no, right? But it's also a very interesting answer because gambling is hardwired into the psyche of humans. I don't know why. I think it's because we are basically pattern recognition and probabilistic computers, biological probabilistic computers. We don't think of ourselves that way, but the majority of what we do, if we're hunter gatherers, we think, if I do this, is it going to get me hurt or killed? What is the likelihood of that happening? Right. And I think that portion of our brain that calculates probabilities probably takes up a really large portion of the brain. Right. And I think that it's something that spills out in sort of like a software error that makes us turn to gambling as a form of entertainment because we're hardwired to do it. So, um, do I think there's potential opportunity in there because people like to gamble? Yes, of course I do. People like to bet on things that may or may not happen. People like to believe in things that they think will benefit them, and that's a very important phrase. People believe in things that they think will benefit them, right? They may not benefit them, but they will still believe in them. And this is something that is evident throughout humanity, all human societies, everything, right? So I'm going to keep doing that. If you notice, I haven't done any videos on any gambling stocks. It's not because I have an objection to gambling. It's something that I just don't do. I understand that it's hardwired for humanity. I just think it's because of the rules and regulations, because of how quickly things change in the internet environment. I'm struggling with making a long-term commitment of my very hard-earned cash to DraftKings. Not that I have a moral objection to it. It's just, yeah. So I'm going to move on to another question here. Hey, Jason, morning from Australia. If we look at Google's YouTube business, which appears to be a cash cow, can you see further consistent growth at YouTube? It seems to have very few competitors. So believe it or not, YouTube is facing a lot of competition from TikTok. Although I did see the news today that looks like the FCC they sent a letter to Google and Apple asking them to remove TikTok from the Apple Store and the Google Store because of concerns over data handling. So I use TikTok really for research. I watch a lot of my political stuff on TikTok just because sometimes I want a biased view of things. I want to know what people are thinking in in the deepest echo chambers, and that's what you get with TikTok with your profile based on the way the algorithm works, right? So I want to know what the people are thinking. There is an enormous amount of data that's collected by TikTok, location data, preference data, all these things. And a lot of insights can be drawn from that. YouTube has that same advantage, but they do have, in terms of like long form They don't have a ton of competition, and there's quite a bit out there. But the problem with YouTube is we're probably going to see a decline in earnings growth, and a pretty steep decline in earnings growth, because of the changes in user data that's being shared with advertisers because of the iPhone agreement, right? When you get a software update on your current iPhone, or you buy a new iPhone, you actually have to opt into data sharing now. It gives you the option to opt out, and almost everyone is opting out. So we're getting less and less targeting data from iPhone users to use for YouTube advertising. And I've seen a decline in my YouTube revenue. Every other YouTuber that I know has seen a decline in YouTube revenue. Now, YouTube revenue is all over the map. I can make $2,000 one month on advertising revenue and $100 the next month, and very little explanation why, other than the fact that I'm just not making a lot of videos. But the reality is almost everyone that I've spoken to, if they're consistent in what they're producing, even if they're growing, they've actually seen a decline in revenue. And if you're in the financial business here, being a financial YouTuber, your pays per click or pays per view or whatever are probably higher than any other industry, because insurance companies, crypto trading companies, those are the people that are advertising on my channel. People that sell financial products, which are extremely high margin products, high profit companies, they're paying a lot to be on these channels, right? So that is a concern, is that we are actually going to see Google's revenue decline because of a change that Apple made in their privacy policies, right? And that's what I think is extremely interesting. Apple didn't do this to hurt Google's revenue by any means. They did this to increase, privacy protections for their users. And believe it or not, Apple really has been on the forefront of protecting privacy for users, like even users that don't deserve it. There was a couple in somewhere here in California, I think back in 2011 timeframe, that shot up the city and killed like 14 people. The iPhone was recovered, and Apple actually refused to help the FBI open up that iPhone, and they said it would set a really terrible precedent when it comes to user security, and they wouldn't actually help them. And both the shooters were dead, and they didn't have, it was a password. They didn't have like biometric entry into the phone. So so I do think that we are going to see their revenue growth decline. We're also seeing other platforms become more popular here. So with TikTok, and something eventually is going to replace TikTok, right? Because the TikTok algorithm is actually just crap. There are so many rules and regulations on that, so many ways that your content gets pushed down by the algorithm based on the things that you say, that you can't, as much as YouTube likes to censor things, and people complain about free speech censorship on YouTube, that's nothing compared to TikTok, which is owned by a Chinese company as well. So George says, I think that AMD is getting close to my buy zone. I think any chip maker, and there are two others that I just can't think of off the top of my head, that are a little bit less obvious, that could be good candidates to buy at this point as well. I think just about any chip maker right now is pretty close to a buy zone. The demand for chips is not going to decline anytime soon. Everything produced in it now needs, semiconductors or, chips, whatever, virtually everything. And the number of those things is just going to increase as time goes on, as more and more things become smart objects. So I did I can't remember the name of the company, but I think the symbol was PI. And they're looking at Internet of Things, basically taking objects. They don't have any sort of computer technology in them, but you're able to use them for inventory control, for tracking and all this, by putting these like tags on them. Even that sort of thing is increasing, where you're going to have objects that aren't connected to the internet that are still on the internet. They're still locatable on the internet because they carry these tags, kind of like Google's AirTag thing. All of that is happening. None of this is going to decrease the demand for chips anytime soon. Our cars are getting smarter. Our watches are getting smarter. Our phones are getting smarter. Everything in our house is getting smarter. I think that AMD in this time period is possibly a really good investment. Of course, you're going to have to do your due diligence to find out whether or not this is an entry point for you, but it's something that I've been looking at too. But remember the chip industry has been really, really volatile for 40 years, right? For almost 50 years, the chip industry has been really, really volatile. So ups and downs, you have to be able to stomach those ups and downs that typically have betas higher than the actual market. It's not for every investor. So Patrick Mulligan says, for ethical reasons, I don't invest in gambling or cannabis. Does that extend to alcohol? So like I understand for ethical reasons. I cannabis is widely accepted as being just a part of normal life in a lot of states. It was definitely taboo when I was younger, but now almost everyone I know enjoys cannabis. I'm one of those people that if I do it, I just go right to sleep. So there's no point in it because I don't get to enjoy it. But I have not made any investments in cannabis because of restrictions here in the United States when it comes to like retail locations, handling cash. Of course, it's still a Schedule 1 drug. I'd like to see it taken off Schedule 1 drug. I would like to see all these dispensaries around me be completely aligned with the rest of the retail industry, so they're not doing business in cash. They can do business with credit cards. We actually know, because I'm fairly certain that we're collecting most of that excise tax on what they're selling here in California. I do not think we're collecting all the sales tax on what they're selling, largely because their business is handled in cash, right? And they are excluded from capital markets in a lot of ways. Like I'm not investing in anything cannabis related that's traded here in the U.S. I might do that in Canada just because you can their retail stores are completely integrated with financial world there. So I may do that. Michael says, I hold GAN back office for gambling companies. It isn't doing well for me. Okay. So, yeah, like I said, this is an industry, like I said, that I just haven't made a commitment to for a variety of different reasons. I would like to go back to cannabis though. There was a point made by someone in my Patreon group, which I never advertised my Patreon when I should, that retail is probably actually a better bet for cannabis because of the lower cost to get into it. If you look at the cost of building out a grow operation in Canada versus the cost of owning a retail operation, it's a no-brainer. You would open up a retail operation and try to make money from there. Here in the U.S., because there's issues with retail and getting them onto like integrating them in the financial world, most people seem to be investing in producers, right, that are putting out a lot of capital to produce these giant grow facilities, and they're not making money at this point. So I think that the industry needs a little bit more maturity and a little bit more clarity in terms of regulation before I would dive into that and make a couple of estimates. So, okay. So Shields just says, sorry for the noob question, but I'm a noob. You said something in your last video being many ways to value a company. How do you prefer to value a company? So it depends on what I'm looking at. Like if I'm looking at Johnson & Johnson, then I'm probably looking at the dividend growth valuation, right? I'm looking at the dividend growth rate, what the projected price is in the future. I'm basically backwards calculating to see the present value of the company and whether or not it's undervalued or overvalued. And that's going to dictate where I buy that company. I'm doing that strictly on a value basis, and it's going to be based on current cash flows compared to expected growth and whether or not that company is undervalued. When it comes to something like a growth company, it's a bit trickier. You're using the price to earnings growth model, basically saying that the current rate of growth they have is the rate of growth they're going to sustain in the future. And of course, there's a tail off as companies mature, which is a lot riskier, right? This is the reason why you come up with valuations of $4,000 for Tesla stock. It's the reason why I have a valuation of $1,500. A target valuation of $1,500 for Tesla stock. I'm a lot more pessimistic than many, and I'm talking 10 years from now. That's my value. It's $1,500 a share. By the way, I should point out that Tesla has blown through all of my expectations of a stock, right? Every time I put a value on it, Tesla blows through it, and I end up not selling it. But currently, that's kind of like my actually, it's my 7-year price target. I did that one about 3 years ago, but that's not based on full self-driving ever becoming a reality, right? That's not based on us ever having a self-driving taxi network. That's just based on energy storage, car sales, and energy production sales. That's it, right? That's a relatively sober and realistic approach to take this company. That's saying a lot of their other things are not going to come true. I'm saying that they're going to produce roughly 7 million vehicles at peak, not 20 million vehicles annually at peak, like Tesla says they are. And my valuation for them is still about, and largely my valuation is that high, largely because I see energy storage for Tesla growing really quickly and really substantially in the next 10 years or so. But I did this 3 years ago, and I came up with a $1,500 valuation at the time. I don't remember exactly what it was, what Tesla was trading at then 3 years ago. Don't remember, but I know that it seemed crazy at the time. But we got to like 1232 or 1282 already in the last 52 weeks. So it's not incredible. So remember, when it comes to a valuation method, that it's far easier to evaluate a mature company on current cash flows and determine whether or not you're getting a good deal. It's not entirely useless when it comes to a growth company, but you should consider that there's a high likelihood that these projections will never come true. A really high likelihood that they're never going to come true. And that has been true with a lot of different stocks that I've owned over the years. I've had notable failures, not that the company didn't grow, not that I didn't make a lot of money out of it, but I ended up making far less than I expected to make out of the company because they were not able to pull off and not what they said they were going to pull off in the time manner that they said they were going to do it. And basically those investments didn't live up to expectations. And that's kind of a failure in a way too. Even though I made money off of those, whatever, that's kind of a failure. And then, of course, then there were the ones that failed completely, where I was completely wrong and they went out of business, right? Yeah. So I had the benefit, like I've said before in this channel, of working at, I didn't work for the company. I was a contractor there. I worked at a company that everyone said was the greatest thing since sliced bread. And I was there while it fell apart. And I was actually literally just doing one of the most boring jobs you could possibly do, which is looking at like financial data at Enron while the company was collapsing. And I kind of didn't know what was going on. I literally came into work one day, and the guy that was in charge of project told all of us that were there, I don't know why anyone told you not to be here, but this company is collapsing and we're going out of business. And we really didn't know. And this is after me working there for like 6 months, and all these older guys were telling me that I was stupid for not investing in the company. They had 100% of their retirement in Enron stock, and all those guys were like programmers in their 50s, so they had not lived through the era where good software developers are making $200,000 to $400,000 a year. They were making $50,000 or $60,000 a year and had 100% of their retirement in Enron stock. So I had the benefit of seeing that even when everyone says something is great, it can still collapse into a ball of crap, right? So yeah, valuation method I use a lot of time is dividend growth model for established companies, which involves using price to earnings, the growth rate, the rate of dividend growth in the past, and kind of projecting that in the future, and then working backwards on an expected basis, see whether that's currently valued, or using the price to earnings growth ratio to determine whether or not a growth stock is going to meet my expectations for the amount of risk that I'm taking. So quantifying risk is another method, right? You want to use something called the Sharpe ratio to analyze the amount of, and this is another thing. You got to take this with a grain of salt, because we're looking at past data here, right? We're not looking at current data, or we're not looking at the future. We're looking at past data. And this is a great question, Chris. I'm going to get to that next. So the when I'm looking at past data, when I'm looking at Sharpe ratio is what amount of return should I expect for a given unit of risk? Meaning, if I'm taking 1 unit of risk, I should expect maybe 2 units of return. The reality is you're normally expecting like 1.1 units of return for the additional risk that you're taking, because there's not a 1-for-1 exchange. And sometimes that ratio is in the negative when it comes to a lot of growth stocks. You're taking a ton of risks, like 1 unit of risk for 0.8% return. That happens quite frequently, and that can be calculated. That can be factored into your calculation as well. I should probably make some videos on this. And like a couple of times I've tried to make really, really technical videos. Nobody watched them. Like I got like 50 views. Even my current subscribers, no one watched them. So, but I should probably do that. It's really interesting, and very few people actually sort of understand this. So, yeah, that's a couple of different things I can talk about. Yeah. So, Demo says, can BRICS change the financial world order? I think that China can, but I don't think Brazil, Russia, and India can at this point. I just don't think that's going to happen. I think that China can, but changing the financial world order. What do you mean by that? Most people think that means ending the petrodollar, right? There are a lot of different things that could mean. And if you look at the financial world order, you really have like four major centers of capital on the planet. You have London, you have New York, you have Hong Kong, and you have Singapore. Everything else is really secondary in that case. This is where all of the new and innovative ideas are funded from. Uh, through Hong Kong, I think that China is learning a lot. The Shenzhen, there's a Shenzhen Stock Exchange, there's a Shanghai Stock Exchange. Neither one of those has emerged sort of preeminent in China at this point, and that would kind of need to be necessary, or China needs to fully commit to making Hong Kong a major financial center. Singapore is probably the weakest one in that group for a number of different reasons. And they're not funding quite as much innovation in the technology sector, but definitely in the financial sector, and definitely in things like e-commerce. They're doing a lot of work there. But yeah, so how are they going to change that? How would China change that? And what about and you don't just need to change the rules in order to change the financial world order. You have to become more innovative. How is China going to become more innovative when they keep slapping on regulation after regulation after regulation, right? And there never seems to be a reversal of regulation. Like the United States tends to increase regulations till it hurts innovation, and then we draw back on regulations. Then we increase regulations, and then we draw back. Definitely not a perfect system. We can't find a happy medium, but it allows opportunity. And I'm talking about technological and financial innovation. It allows windows of opportunity to create new means of exchange, new means of doing business. This is what a lot of these other places are doing, like right now. Like London is really just doing financial innovation at this point. They're not doing a ton of tech. I know this is going to get me some criticism. I'm going to get a couple of nasty emails from this. But when you look at, whoops, sorry, I just got an email from one of my tenants and one of my rental units. I need to look at it. So, let me see here. Will you buy ARM if and when it POs? And yes, the answer is yes. I will buy ARM when the IPO. If you guys don't know who ARM is, they're a chip maker, and they are worldwide, but they do a lot of business in Europe. Yeah. So, but back to the BRICS. I don't have a lot of faith that Brazil can get their financial house in order. A lot of that has to do with a number of social ills that they face that the country needs to address. And the same is true of India, right? Russia is a complete financial wreck. Even without the war in Ukraine, they are a complete financial wreck. As a result, really, as just a tiny, tiny portion of the population controls the vast majority of their wealth. I think this is best illustrated by this. Per capita GDP prior to the war, it was about 10,500 in Russia and only about 3,800 for Ukraine. Yet, when Russian soldiers are coming to invade Ukraine, they are uniformly astounded by the amount of wealth that the average Ukrainian has compared to them. They're stealing washing machines and lingerie and everything they can steal. They're taking it back to Russia because they don't have it there, or they're trying to make a profit on it, whatever it is. But what they're saying in the captured phone calls and texts is that they're actually astounded at how wealthy Ukrainians are, when the per capita GDP of Ukraine is actually only a third of what Russia's is. And that's because wealth is concentrated in too few hands, right? They would not be able to do that. I think China is kind of the only candidate out there that would be able to, and definitely not South Africa at this point. South Africa's capital markets are not really well developed at all. So you're really looking at China as the only game to do that. and their only avenue to do that is through Hong Kong, meaning they've got to start attracting companies to go public on Hong Kong's exchange, to create a really robust fixed income market to finance some of the changes that they want to make with the petrodollar, right? And I don't see that happening soon. I do see it as a definite possibility. So it's not the BRICS that are really going to make a change in the financial order. It would just be China. That's it. Brazil, Russia, and India and South Africa would likely not really be all that important in that equation, except that they buy Chinese products, right? But they aren't China's biggest trading partners by far. It's us, right? And based on how China controls the way their currency floats against ours, it hasn't been a huge detriment to them to basically do business with us in dollars. It really hasn't. So I don't think that China wants to upset the world financial order. They're fine being like, I think they want to be the largest economy in the world in a lot of ways, and they want this change to happen naturally. They don't want it to happen sort of like in a hostile way. So that's a very interesting investment / geopolitics question that I could talk about forever. I'd love if there was an actual like political science person listening to this who'd love to come on my channel to talk about something like this. If I'm wrong about things, just slap me down and correct me publicly. I don't have a problem with that. I really don't. You guys, I really don't have a problem with that. I respect expertise. And I really respect expertise. Sometimes I have a differing opinion, but that's going to be based on research that I've done or experience that I have. And I'm willing to discount my own experience, being perfectly aware that it could be biased in a lot of ways. So, but will I be buying ARM? So I'm actually a little disappointed that the ARM NVIDIA merger wasn't allowed to happen. And I don't know if it was the SEC or the Europeans that actually objected to this. It may have been the Europeans that objected to this. I'm not really sure. But when that IPO happens, I'll definitely be buying into that. But I'm not going to be buying into that until 2 or 3 quarters down the road. I think that the IPO market, number one, most IPOs really don't do all that well post IPO for quite some time. And you can always stand to wait around a little bit and get a better price. I think one of the best examples of that is Snowflake. If you look at Snowflake's earnings growth and you look at the sort of potential they have for their market, I think that now is probably it's a better time to invest than we've had since they've gone public. A number of different things we could talk about like that. In a lot of ways, though, I look at Snowflake and I'm like, well, if I'm going to buy Snowflake for their AI capabilities and that sort of thing, and what they're doing in terms of data flow management, like, why wouldn't I just buy Amazon? Amazon is doing everything that every other AI company is doing. And right now, the kind of only AI companies I'm really interested in purchasing right now are ones that have an inside track when it comes to like government contracting. Everything in the financial sector, I think, is eventually going to get absorbed by Google and Amazon. They're going to keep buying people that compete with them, and people are creating companies right now for the sole purpose of being acquired by Google or being acquired by Amazon. And that is a business strategy that a lot of people don't know about. Like, I'm thinking about taking a line of beer and promoting it with the sole intention of selling more than 1,000 barrels a year. So some mid-level consolidator is interested in our company and will buy me out for $30 or $40 million, right? There's an entire line of business that works that way. I did this with a software company in the late 1990s, did this with a technology company in the early 2000s, and hoping to do, and I wasn't the only person involved in these projects. Otherwise, I'd be, living it up on a beach somewhere, right? But meaning I didn't make all the money. I had to share it with the other people in my company. But this is something that's going to happen more frequently in the future. So the AI companies that I'm looking at have a specific line of government work that they're doing that I'm very much interested in. So so it's been an hour and 24 minutes, a little bit longer than my normal live stream. Thank you guys for tuning in today. I've had a little bit of trouble getting content out recently. Part of that has to do with I've been very interested in something. Is it correct that stimulus checks are back? Anthony, I haven't heard anything about that. And to be honest with you, I didn't pay as much attention to it when it went around the first time because I didn't get any of it. In California, yes, yes, those are coming back. And once again, I didn't qualify for any of that. And a lot of folks outside of California aren't aware that there's already been 3 rounds of stimulus checks, for California residents, and it looks like we're getting another one. But I think it's for households that have under $75,000 a year in income. But I don't, like I said, I haven't paid that much attention. I think the first round was like 600. The next round was 1,100. Then there was a $500 check, and now there's another round coming out possibly. But it's other states could follow, is what Anthony Walker is saying. So the reason why California is able to do stimulus checks is because we pay too much in taxes, but paying too much in taxes has actually resulted in large surpluses. I think in 2019, there was a $30 billion surplus. It was, like $30 billion in 2020 and $70 billion last year in surplus. I hear this from like Facebook friends who live in Texas all the time that California is broke. Like, I don't know, man. If we got $70 billion a year surpluses, it doesn't sound like we're broke. But that's the only reason I could do that. I'd rather see California cut taxes than see people get a stimulus check. And even for taxes on the wealthy, that has spurred some top innovators out of the state in the last couple of years. And there comes a point where you're just paying too much in the way of taxes. And as someone who owns multiple businesses in California, the fees that I have to pay, to just the filing fees that I have to pay for those businesses every year, is more than than anyone who makes under $100,000 a year is paying in taxes. Period. Right? Just the fees I have just to have my companies. That's more than the entire tax burden, state and federal, that somebody makes $100,000 a year is paying in California. Which that's bad for that's bad for me in terms of my savings, but it's bad for innovation as well. It discourages people from getting more, from getting into business in a lot of ways. But anyway, thank you so much, guys. Thanks for tuning in. I'd love to see more people tune in, more people throw questions my way. I've said a couple of times on this channel that I didn't know or I don't have an answer, and I'm happy to do that. I'm not just going to make stuff up. So yeah, I would love to hear from you guys tomorrow. I'll be back at 1:00 tomorrow. Thank you so much.